Great. Well, thank you so much, Amy, for your help with all this. And it's a pleasure to be here today, and it's great to be part of today's webinar. So today we'll talk about some best practices for cash flow forecasting and budgeting. So we've got a very large group attending today. I looked at our Zoom list here, and we've got 290 attendees. So just imagining you all in one big room, that's a big group. So I looked over the list of attendees today and just noticed that we have a very diverse group of people attending. So we've got CFOs, we've got controllers of some large and mid-sized companies, and we also have some small business owners, and they're from all types of industries and nonprofits. And so I'm sure you're all using a very wide range of software to do your accounting in your organizations, but I hope that all of you will find some part of today's content relevant to you and to your organization, and that you can come away with a few best practices and strategies that you can implement in your organizations as it pertains to managing cash flow and budgeting. And since we're near the end of the year, maybe some of you are just here because you need the CPE, and that's great too. So we're glad we can help you out with that. So I'm going to introduce today's presenters. First of all, here myself and Heather Hootery and Jackie Brooks. So all three of us are part of Eide Bailey's outsourced and managed services, and we provide outsourced accounting services, including payroll, accounts payable management, accounting process improvement, basically relieving all of those administrative burdens from our clients. And we also advise management with financial modeling and decision making, and at times participating in board meetings to do all of that work. And we do all of this using cloud technologies that helps us to best collaborate with the companies that we work with. So my name, Dustin Wheeler. I'm located in the Lehigh, Utah office of Eide Bailey. I work with our partners, staff, and clients all across the country with a focus on leveraging accounting technology to automate accounting functions and better advise the companies that we work with. So we also have the great fortune to hear today from two of my colleagues who have some great financial knowledge and experience, and I've had the opportunity to work with both of them closely, and they're very proactive in finding ways to improve accounting processes. So Heather Hootery, she is an outsourced accounting manager, and she's in our Fargo, North Dakota office. And Jackie Brooks, she is an outsourced accounting senior manager located in our Tulsa, Oklahoma office. So as Ali mentioned, if you have questions during this webinar, please put them into the Zoom Q&A, and the three of us will monitor it and we'll respond throughout the webinar. We also plan to take a little bit of time at the end of the webinar, the time we have left, maybe 5 or 10 minutes, to answer some of those questions live. Okay, great. You see on here a board game, Ebeopoly, Eide Bailey themed Monopoly board. So last year, and really to some extent this year as well, we've socially distanced during COVID-19, and my family has found some new activities to do together. Others have been prohibitive, but we've gotten into some other things that we do at home, like board games. And I think we can learn lessons about managing cash flow from board games and some video games as well. But one that I've enjoyed since I was a kid is Monopoly. So what is the objective of the game Monopoly? Well, it's not to have the most money. That certainly helps, but the way you win is by giving your opponents a cash flow problem and driving all of them bankrupt. So I'd like to tell a personal story here. This happened last year. And you might think I'm a mean father after I tell this story, but it's all in good fun. But I was playing Monopoly with my two oldest boys, and my son, who is now 10 years old, he desperately wanted a Monopoly. So that means he wanted 3 properties of the same color. So some of you might know how kids this age can be when they really want something. So he says, "Oh, Dad, can we trade?" So I drive a hard bargain and I say, "Well, sure, I'll give you Pennsylvania Avenue, but I want St. James Place and I want $400 on top of that." So my son agrees, and he's very excited that he's got a Monopoly. And then he buys a couple of houses to put on it. And then he's left with like $10 of cash, basically broke. And when he lands on other properties of mine and my other sons, then he has to start foreclosing his properties to pay the rent. And the game really penalizes you when you do that. So he goes on to go bankrupt and he loses the game, but he's really disappointed with the outcome. But afterwards, he and I just had a really good talk, and I shared some strategies that I use to try to win the game of Monopoly. So really, how we talked about how to better manage your cash flow. And it was great to see him learn this lesson. The next time we played, he just improved how he managed his money in the game. So I hope my kids can learn these lessons to play with play money, and that someday these lessons will translate into the real world. But it is heartbreaking, though, to see businesses fail and the impact that it has on employees and business owners and their families. So in some ways, a cash flow crisis is kind of like stepping off the curb and getting hit by a bus. So if you don't look both ways, you can be blindsided. But if you are regularly forecasting your cash flow and establishing a budget, you just may see what's coming and you may have time to evaluate your options. So with this bus analogy, maybe you take a step back on the curb. Maybe you try to wave down the driver if you see the bus on its way down to you. So similarly now in business, if you know what's coming, you may have time to get a loan or get funding or make an effort to change the timing of your receivables and your payables and all of that. There are things that you can do. So when we talk about how to forecast cash flow, the first thing that we need to understand is the cash flow equation. And this is very simple math. We start off with how much cash is in the bank today, right now, and we add to that cash inflows. Now, notice that this equation is not the same as a profit and loss or an income statement. So cash flows include income that comes in the form of received cash, such as deposits from credit card, merchant services, and electronic payments and paper checks. But the definition of cash inflows includes a lot more than just income. Now, this money could be loans or lines of credit, the sale of fixed assets, could be capital contributions from owners. The defining factor is that the payments coming in aren't cash flow until you have access to the funds in your bank account. Okay, the next step is we subtract out cash outflows, and this could be checks that you write for expenses or debit card transactions. But similarly, the definition of cash outflows includes more than just expenses. So it could be payments you make for a loan, but remember that both principal and interest count for cash flow purposes. So it could be distributions to your owners. So to sum it all up, outflows of money aren't considered part of the cash flow until they leave your bank account or they leave your pocket. So you do this very simple math and you get to what will be your future cash balance after these events have occurred. So this is super simple math, right? Well, this may be a very simple equation, but the art of forecasting cash flows gets a lot more complicated. The truth is that it's a real puzzle to decode when the money is likely to come down and go into your bank account. You have to take into account things like seasonality in your cash flow, and you have to worry if an outgoing payment happens before the money comes in to cover that expense. So there's a lot of questions here to consider, which I've typed into these bubbles of thoughts here. So some things to think about. When will my customers pay their invoices? Should we pay off our debit card? What if we buy a building, or what if we buy something else? Can we afford it? So you suddenly have a ton of variables here to consider how this whole thing is going to work. And the tricky parts here are predicting the timing of when these events will occur and evaluating the alternatives. So there's a lot of software out there that can help with the math. It can analyze the receivables and the customer's payment history to estimate when collection of receivables is likely to occur. And software can identify what transactions are recurring and which ones are likely to continue. But there's still very much a human element that goes into forecasting cash flow. And you, as the business owner, the accountant, the CFO, whatever your role is, you'll need to use your understanding of the business to answer some of these questions along with the data. So when we talk about how to forecast cash flow, the first thing that we need to understand is we'll need to look at the importance here of our cash flow. So I'm going to share a few statistics here, which I really think are really quite sobering too. So to be completely upfront about these, I didn't research them all myself. I got these statistics from a book that I read called Pandemic Cash Flow. Now, interestingly, this was written and titled before the COVID-19 pandemic. So the title is actually very coincidental. But half of all businesses will fail within their first 5 years, and cash flow is the leading cause. 30% of businesses will fail due to cash flow issues alone. 82% of every business that fails claims places blame on cash flow. And according to FinPacific, 70% of businesses that fail are profitable when they close their doors. So I'll pause here because I think this one deserves some commentary. So how can a business fail while being profitable? Well, you can be profitable on paper and have $1 million in receivables. So revenue is not the issue, but the problem is not having enough cash on hand to cover your costs while those expenses need to be paid. Or maybe a company has just spent too much money on equipment or fixed assets, and frankly, they couldn't afford them. And the final one here, so further, they note that businesses only planning once a year to have a 36% survival rate over 5 years versus those planning monthly, which have an 80% survival rate. So there appears to be some correlation to business survival if you're monitoring cash flow more often as opposed to less often. And as terrifying as these statistics may sound, the greatest tragedy of all these is that they're not just numbers. The numbers represent people and their business owners with their life savings on the line, and families that they support, and staff that need paychecks to keep their households running. So let's look at this question right here. Are you at risk for a cash flow crunch? So here's some questions to ask yourself, and I got these from the book, and you can download these questions from this link that you see here on the page. Later on, I'll paste this into the Zoom chat, but I want to go through these questions slowly and just give you a little time to think about your answers for your company. So number one, how do you get paid? Well, the lowest risk is getting cash payment since you have the cash on hand. Higher risk comes from having receivables and getting paid later if you're paid at all. Number two, how big are your individual sales? Well, numerous small purchases can lower your risk. Your cash flow is spread out over a larger number of transactions. And if you have larger sales, a smaller number but larger amounts, you have more risk. Number three, how often do you get paid late? Well, the longer a payment sits, the more likely it is that you won't get a full payment, or even worse, that the customer will just refuse to pay you. So number four, how large is your monthly budget? So think about your recurring expenses and how long you can go during lean months and keep your doors open. Number five, how do you pay your largest expenses? So although bills that need to be paid at a later date need to be carefully tracked, ensure that you're paying your bills on time, but not necessarily early. Number six, how often do you pay your bills past the due date? Well, sometimes bills simply need to be paid late in order to prevent your business from closure. But keep in mind that oftentimes paying bills late will have a negative effect on your work. It can hurt your reputation, your relationships with your vendors, and late fees. So keep that in mind. How fast are you growing? Well, growth is a good thing, but sometimes growing too fast is a root cause of many business failures. Number eight, how do you fund expansion? Well, there may be circumstances when funding growth through cash flow is your best bet, and other times maybe you need outside capital or debt. Number nine, how big are your savings? Well, your savings give you a safety net, and the more cash you have on hand, the lower your risk of a shortfall. So, but now on the other hand, cash just sitting idle in the bank account is doing little for your business. So there's certainly a balance to be had. Number 10, have you ever missed paying yourself? If you're unable to pay yourself on a regular basis, or even to more extreme, constantly investing money into your business to keep it afloat, you're in a very risky situation. So hopefully going through these questions has been helpful to help you evaluate your risk. And now I want to go through a few financial metrics that you can use in your business to diagnose problems with cash flow and see how financially healthy your organization is. So number one, days sales outstanding. This one takes the accounts receivable balance divided by the sales for a given period and multiplies that by 30. You see that in the example right here. The purpose of this one is to measure how long on average it takes to collect receivables from your customers and understand how many days of revenue you have sitting in accounts receivable. So the time frames you apply to this calculation are critical. So you want to carefully consider the dates you're using, and perhaps use an average accounts receivable balance and average sales for the last 3 months or so. You only use credit sales in this calculation because same-day cash sales can skew this number. Next one, days payable outstanding. You could say this one is the opposite of the first one. It takes into account here the accounts payable balance divided by purchases times 30. So this one gives you an average of how long it takes to pay your vendors. So when you calculate this one, you'll need to know what things you have in accounts payable, such as rent or payroll. Some of those can skew this calculation. So now that we have this numbers, we can compare the days sales outstanding and the days payable outstanding and see how fast we're collecting versus how fast we're paying. So in these examples, we're not collecting receivables very quickly, but we are paying our bills very quickly. So if our company is in a cash crunch, that may be a big reason why. And so we may want to think about ways that we can speed up our collections and think about how we can pay our bills on time, but maybe not necessarily early. So another number to keep on an eye on here is days cash on hand. So this one takes your cash on hand and divides it by the operating expenses, which excludes non-cash expenses such as depreciation, and divides that by 365. So what we're calculating with this ratio is how many days an organization can survive without revenue and continue to pay its operating expenses. And this became a hot topic last year as many businesses were shut down for a period of time. I'm going to, oh, there's the calculation there of how to calculate that. But think about this question: how much of a cash reserve should you have? We get asked this quite often. So I don't have a one-size-fits-all answer, and it's going to depend on your type of business, the size of your business, but there are some industries that average more cash on hand than others. And so the link that I have here in yellow, and I'm going to shortly paste that here into the chat, but it's a study by JP Morgan Chase, which was a few years old now. It was done back in September 2016. Notice you've got a polling question up, which you can go ahead and go in and answer. So to be clear, I'm not recommending that you follow the statistics in the survey for the number of days cash you should have on hand. But it's a good measuring stick to see how you compare to everyone else. So when you look at this, you can see in here that restaurants, the median cash buffer is only 16 days. So that may be because they operate on low margins, they have a high labor to sales ratio. And it was unfortunate in the pandemic. A lot of restaurants closed down and were really hit hard. You'll also see in here that that 25% of businesses, so this is the lower half, they have less than 13 days of a cash buffer, and that just doesn't offer much margin for error. Now on the other side, the top 25%, they have 62 days or more of a cash buffer. So it'll be interesting to look at. I'll paste this in the chat. You can take a look at the survey. But for now, I'm going to pass the presentation over to Heather Hootery.
All right, thank you, Dustin. So now we're going to dive a little bit deeper into some of the concepts that Dustin kicked us off with. And I wanted to begin by sharing this quote by Michael Dell. So Michael Dell says, "We were always focused on our profit and loss statement, and cash flow was not a regularly discussed topic. It was as if we're driving along watching only the speedometer when in fact we are running out of gas." And I think it's so easy for us and business owners to get caught up at looking at an income statement and focusing on top line revenue and even aligning their team's goals to match those metrics without sometimes considering how cash flow would impact those decisions. So that's some of the importance of considering cash flow when you are working in your planning. So let's take a look at a handful of best practices when it comes to cash flow. The first of which being is know and calculate your cash burn. So your cash burn is the amount of cash that you need to consume over a period of time. And this is an essential starting point when you start to do your cash flow projections. And then when you're calculating this number, make sure that you are considering fixed costs versus variable costs, so that as you project out, you can flex that variable component up or down in tandem with your revenue projection. Monitor your forecasts frequently. So once you have a good model set up, it's important to keep it updated on a regular basis so that you can proactively address any action items that pop up. So I find that weekly is a really great cadence to use if you can. But at the bare minimum, I would say monthly is how often that you'd want to be updating your cash flow forecast. Um, Invoice promptly and collect quickly. So making sure that your sales team and workflows includes a process of getting that invoice out the door as quickly as possible if you're invoicing on terms. So, and then in addition to that, working with your customers on their preferred method of accepting invoices, like so snail mail versus email, that kind of thing. But consider if you are still sending out paper invoices in the mail, it could be that your customers are only checking their PO box or wherever that ends up going once a week or so. So it might even be 2 weeks before they even see your bill to get it paid. So we'd like to recommend that best practice is to, of course, listen to your customers and work with their expectations, but consider invoicing electronically so that they can see that invoice right away. And then in addition, work with them on offering convenient payment options that can expedite the collection of those bills. Review your purchasing policies. So this is a take from the vendor perspective, and you'll want to work with your vendors, take a look at those terms that you have set up with them, and make an effort to align them with the way that you're invoicing your customers and the way that your customers pay you to avoid a large gap between when you're getting your cash and when your vendors need to receive cash from you. So in addition, if you have vendors that you use frequently, reach out to them and discuss if there's any opportunities to set up accounts with credit with them, so that maybe instead of paying them every time you swipe your card at the hardware store, they could send you a weekly or monthly statement to pay off of. And use technology other than Excel. And I do love Excel, but now that I've had the opportunity through my work to use several different cash flow tools, I understand that while it doesn't give 100% of the flexibility that Excel can do, it gives us enough. It's worth the sacrifice to automate what we can if it means that we're able to update our projections more frequently. They're just less painful to keep up to date that way, and they use a lot of other nice algorithms to help us even set up the projection in the first place. And have a trusted business advisor. And I wanted to just put this point in here as a reminder that you're not alone in this process. Make sure that you pull in your CPA, your other business partners, or ideally both. Get a group together to brainstorm ideas, create action plans, and to hold each other accountable. So if you're in a position currently where you're looking how to increase your cash balances, I wanted to talk about a few ideas of where you could start looking and analyzing. Your receivables is a low hanging fruit if you invoice on terms. So take a look at your aging schedules. If you have particular customers that you can focus on that might be past due, or just in general, if your trends are aging more to like 90 days instead of 30 days. I love the saying, the squeaky wheel gets the grease. So what that means to me is it's important to stay in touch with your customers and try multiple methods of communication if you find that you're not getting the response that you'd like. I personally find that phone communication can be really beneficial because emails can be so easy to delete and ignore if your customer is having a hard time with cash themselves and just is afraid to reach back out to you. Um, Also consider what terms you have with your customers and your payment method options. Again, should you consider breaking up large payments into smaller, more frequent ones, or considering accepting credit card or ACH payments as a method that might be more convenient for your customers? Another area to think about and consider is, who do you have on your team that's keeping up with receivables on a daily or weekly basis? If you don't have anybody that's responsible for collecting those balances, it might be worth consider reallocating existing staff time to that initiative. Another area that cash can get held up in is your inventory. So if you're not analyzing those balances on a regular basis, that can be very valuable. And take some time to slice and dice that data at the SKU or product group level. Thinking about, do you have SKUs that aren't turning? Are you focusing sales efforts on SKUs that have lower margins? One metric that you could track if you're not already is your days sales of inventory, or in other words, how many days it takes you to turn your inventory. And you can compare that to your industry standards and also compare it to your own business over time and see how that's trending. So for example, maybe you used to have your day sales inventory turning at 30 days and today you're trending closer to 32. And that might not seem like a huge difference, but what we can do is take and turn that into a dollar value, and you can decide for your business and organization if that dollar value is still within your comfort level. And same with analyzing receivables. If you don't have anybody analyzing your inventory balances on a regular basis, it could definitely be worth reallocating some existing staff time to doing so. And in some cases, we found for our clients that even adding a position for an inventory manager has provided enough value to pay for itself. And we'll go through an example on the coming slide on how you can do some of these specific calculations. I won't spend a lot of time on these next two. We've talked a lot about negotiating vendor payment terms already. So just a reminder to negotiate where you can. And then lines of credit are always a good option, especially if your business is seasonal. So here I put together just a quick example of how we could measure a day's sales of inventory for you. On the left-hand side, you'll see just a very, very pared back financial statement example. So up in the top section, we've got a balance sheet ending September 2021 and October 2021. You can see that the inventory balance was at 65,000 and increased slightly over the next month to 70,000. Below on the income statement, you can see our cost of goods sold in September was 400,000. In October, it was 390,000. So these don't seem like very significant changes from a financial statement perspective. It might not have caught anybody's eye and we just carry on with our day. But if we were to calculate the day sales of inventory and compare September to October, you can see that in September, that calculation came out to 4.88 days. And then in October, it was 5.38 days. So if we convert that to a dollar value, that's $13,260. So that's the impact, the dollar impact that that change in inventory has had to your business. So just thinking about if that number is something you're comfortable with, just carrying on and continuing to track that. But if you see that dollar value start to creep up and make a major impact with your business, what can you do to get that number back to a level that you're comfortable with? So then we get to the point where we can start modeling our cash flow forecast. And we always start with the base, thinking about that formula that Dustin was talking about just a bit ago. What cash do you have on hand today? What inflows do you know that you have coming in? So a good place for that is looking at what do you have outstanding in AR, or what is your average daily sales if you don't invoice on terms? What outflows do you know that you have coming up? Thinking about recurring payments, things like rent, as well as variable or one-time payments. And again, I like to forecast on a weekly basis, but monthly is also pretty good. From there, we'll start to evaluate critical factors for your business. And these critical factors will determine the types of scenarios that we run alongside your base forecast to help us plan for best and worst case scenarios. So when you're trying to think about some of the factors that come into play here, you'll want to be very specific to your industry and your business. For example, if you're a project-driven business, you might want to think about what would happen if there would be a delay in a deliverable to your customer, and even go so far as to say what might cause that delay. On the other end of the spectrum, you could be thinking and planning about growth. So a scenario we recently helped one of our clients with was planning for a small medical practice. They needed to bring on another practitioner. So we wanted to take a look at what revenue goals were reasonable, how that would impact staffing and other variable costs, and then backing into what a reasonable production goal would be for that new provider. So it can be really fun and exciting to think of a lot of these ideas and start just running as many scenarios as you can think of, especially for, I mean, I think that sounds fun because I'm an accountant, but we want to remind ourselves that modeling out a ton of scenarios and what ifs, it can be a lot of work and difficult to maintain. So we want to try and keep that amount that we're running reasonable. And usually I'll just throw out 5 scenarios as kind of a good place to start. Now from there, you'll want to, of course, again, bring in your business advisors and colleagues so that you can create action items and plans and start defining some measurables on these forecasts so that you can keep your team accountable and take action when needed. And Jackie's going to dive a little bit more into this when her section comes up here shortly. All right. And then we wanted to show a quick example of one of the cash flow tools that we use internally and how all of this comes together into what you could see for your business. So here, it's a very simple scenario. In this top section here, you can see the base cash flow forecast. And then below that, we've got a scenario, what if I receive a bank loan? And so it's really easy to compare side by side in both a table formatted view, as well as if you look above, it displays it in a graph. So it's really easy to visualize. From the table view, you can drill down onto each section, see what details make up the numbers, and shift things around as needed. And this tool and the other tools that we typically use do integrate with your accounting system. So it's really easy to keep updated and maintain. And also, it does assist with building out these forecasts for you by using algorithms and forecasting things out in a really easy fashion. So. All right, so with that, Jackie's going to take over and talk some more about some annual budgeting.
Thanks, Heather. It looks like you guys have a polling question. So as you're answering that, we will move on to this slide. So this year's webinar looks different for me personally compared to 2020. Last year, I had all 3 boys at home. One had music class and was banging drums in the middle of my presentation. We had a toilet overflow. It was a mess. But this year's a little different. You know, kids are in school for most of us. People are back at work. But what hasn't really changed from 2020 is the uncertainty. So as we continue to crawl out of this pandemic hole with this continued sense of financial risk or instability, I thought this quote from Robert De Niro was fitting. Sometimes if you have financial restraints, it's a benefit. It forces you to come up with a more creative way. So yeah, we can use these times as an opportunity to look at our organizations and budget plans through a different lens. So in order to change our focus, we first need to move from our tendencies to go line by line down our financial statement and trying to move, you know, things from here to there and simply trying to match the previous years or other things. I know we're all guilty of this. It's an easy thing to do. But what we really want to do is shift to planning for strategic success. So what does it mean to budget for strategic success? It means looking at your budget as a plan for higher performance versus a predictable return or, you know, a certain bottom line. So instead of the goal being a certain number, the goal now is to improve the outcomes for our customers, our employees, investors, and even our community. And we would do this by focusing on learning, adapting, and growing. Because we can't really predict the unpredictable, but we can definitely be strategic. So just some examples I'll give you to kind of just get your mind going in this direction. Looking at higher performance from a customer perspective, ask yourself, what was the level or quality of customer service and engagement with customers during the pandemic? Were we more engaged, less engaged, or maybe about the same? What are the things we need to do in 2022 to either improve upon that service or even continue it? So depending on what your answers to these questions are will depend on your focus and on your strategy. So for example, do we need to know our customers better? A strategy would be taking them out to social outings more often or collecting customer data or feedback. Could we personalize services, provide product training, or even connect with our customers through social media? So now looking at it from an accounting standpoint, we've talked about this with Heather and Dustin, but are we current on our collection times for accounts receivable? Are they extending beyond what we pay our vendors? If so, we may need a strategy to improve those collections, just like Heather talked about, implementing online bill payments, emailing invoices, maybe even getting with a collections agency if they're really that bad. Now, looking at higher performance from an employee perspective, this one is a bit tricky with certain pending legislations. However, most businesses, we're all in the same boat. We're needing to regain staffing levels. We need to retain existing ones. So it's causing quite a bit of competition in the hiring market. So some strategies from an employee standpoint could be implementing performance-based bonus plans, getting creative on incentives like gym memberships, free counseling, workplace flexibility, maybe even giving home office stipends. You want to increase your training by assessing the specific needs of each of your employees and determining how they can be valuable assets in the process of strengthening your business. For me personally, good coffee and snacks would be a good investment. I'll be a happy camper. Investors, increase your interaction and transparency. You know, this may be depending on what type of industry you're in. You could be a nonprofit, so your investors could be board members or donors, but increase interaction and transparency. So you can do that through phone calls or text messages, providing information on your website, through email and even mobile apps. So with that, you want to also consider them as a team member. Don't try to hide information. Think about providing dashboard information with KPI metrics that they could have access to. So budgeting for software or the time investment in reporting to investors or board members would be important. And then community, you know, allowing for time to volunteer and donating resources would be considered when you're budgeting. So from here, we take these outcomes we've identified for higher performance, and we continue to ask questions, figuring out what activity needs to happen to achieve each of those. And then we determine what resources are going to be needed for each activity and goal. So this slide, this is a great resource for you as you begin this process of budgeting for strategic success. The questions came from the Harvard Business Review's article called An Agile Approach to Budgeting. So we've included these great thought-provoking questions here to use with maybe some of the outcomes we just identified from the previous slide. So in the interest of time, I'm not going to go through all of them. Definitely want Dustin to get his last words in, but I did want to use this slide to give you a great example of an industry that's hard to project or budget for, which are commodities and industries that are driven by commodities. So there's so much volatility in those industries, but some companies I know of in this industry during the pandemic took on the typical and obvious approach by issuing layoffs and just overall expense reductions. However, I also saw some get creative. They saw an opportunity for innovation during the pandemic. One invested in technology to control the electrical costs on their wells, so that reduced their overall operating costs. Another company who leases equipment got innovative and invested in some technology to track the usage of their leased equipment so that they could ensure that it wasn't being ran more than what was stated in the agreement. So the bottom line here is that just going down line by line is not going to create higher and better performance. We are all about quotes in this webinar, so here's another one that's good. Never let a good crisis go to waste. Yeah, from Winston Churchill, because this is where some of our greatest opportunities may come from. So in order to make sure our strategy-focused budgets are successful, it's not to lose sight of those fundamentals. So here are some best practices to implement for our budgets. First, Standardize your data and processes, which means making your methods and processes uniform or consistent throughout your organization. This can be done by taking out manual methods and processes and then replacing them with automated tools, because manual errors do create inefficient budgeting. Also, within the standardization of your data, consider cloud-based systems if you're not already on them for more accessible data, and then automate your processes from there. Ask yourself if you're getting the most out of the tools that you're currently using. You may find that there are newer features out there that you haven't even tapped into. Second, focus on drivers. Not only would we focus on those areas we just identified in the previous slides, but also for our drivers, we should include non-financial data. So for example, we discussed earlier improving our outcomes for customers. So a good non-financial metric for customer satisfaction would be using a Net Promoter Score and tracking that. You may find that there's some areas that really are serving your customers from the customer's perspective, and then there's actually might be some areas that are really struggling, and that will help you identify how you should allocate your resources. Third, continuously evaluate your past performance. If you were in business, or if you have similar peers that were in business during the 2007 to 2009 Great Recession, look at that performance and see how the recoveries went after that. You may find some strategies within those results, or you also may find some things that maybe you shouldn't do post bad times. Next, involve all of the leaders within your organization. This is a budgeting. The budgeting process is not just for the accountant. You need your whole leadership team. You want to include them on setting the budgets because they have plans and you need to know what they are. And it also helps keep them accountable during the year to their plans, and just opening up the perspective as it relates to them. We also should create smaller budgets. You can do this by department, you can do it by product or program. Next, you would want to update the budget frequently. Once a year is just not enough. It's not effective. I do want to note here that there are things that constitute an update and things that do not. So this isn't technically an absolute. We just want you to be aware that a budget isn't set in stone, because if we've learned anything from 2020 is that things can change in a matter of minutes. So we must be willing and able to adapt. So now, using your budget to plan continuously, you want to plan continuously, and you want to set up review cycles. That should be an absolute, whether that's monthly, quarterly, or some other frequency, but do it more than just one time a year. You'll want to revisit that annual budget that set your initial targets, and you could use rolling forecasts with new and existing assumptions to see where you stand from month to month from your original budget. I like rolling forecasts. They allow us to project future results, and it's done by using your actual year-to-date financial results with your original budget. And finally, just from a cash flow, just like Heather was talking about, from a cash flow standpoint, also from a budgeting perspective, you want to model out different scenarios using some of your strategic objectives, and also any unique challenges your organization, industry, or even your goals may create. So spend some time thinking about those critical scenarios that could throw a wrench into your base forecast, and keep each one in your pocket as well. Even if you don't use each one for your budget, have one there. Because like I mentioned before, circumstances may change that require a change in strategy and in resources. But you'll be prepared if you have different scenarios that can help you execute your plans quickly and efficiently. So in addition to shifting your focus, like we discussed, there are some additional things you can do to further maximize your overall cost reductions from a budgeting standpoint. The first few ideas are the most common and have probably already been done by now, such as layoffs, rent or lease reductions or eliminations, lowering your insurance premium payments, and debt refinancing. However, also consider taking a look at your advertising. Some companies, and maybe some of you are guilty of this, may still be paying to run ads in the yellow pages or just in the newspaper, maybe places that people really aren't accessing. But don't say no to advertising and marketing in total. Just make sure that the marketing is strategy focused. For example, does your advertising gather information about your customers or potential customers that could actually prove useful when things do start turning around? Some ideas that are not so obvious would be consolidating activities by combining events across multiple departments, like training days and celebrations into one event. But it's also similar to activity consolidation. Take a look at your department and see if there are duplicated efforts across your departments or programs. Can we do the activity one time versus several? So shift some of those burdens to the most efficient locations so that they can do what they're good at a lower cost to the company. Reduce spending on department management. Administrative activities typically don't change year over year. So if the investment and the supervision can be done up front, we probably don't need that same level of management's time year after year. So take a look at that. Over time, also administrative processes tend to stay the same, despite the fact that they may begin to become inefficient or possibly ineffective, or frankly, not even necessary. So take a look at your administrative processes and determine which areas are in need of a change. For example, as your business has evolved, has the need for certain data disappeared? Or where do you use people to process information repetitively that could actually be done electronically with little to no humans? And overall, just strive to eliminate any work where the cost exceeds the value. Understand where the value in your organization lies. If you look deeper, it may not be in those traditional budget line items that we typically put our focus on. Because, and here's another quote, because we love them, not everything that can be counted counts, and not everything that counts can be counted. And you've got another polling question. And with that, we'll move it back to Dustin.
Great. Well, thanks so much, Heather and Jackie. So this is just another reminder, if you've got questions, put them into the Q&A. We've only got one so far, which I'm going to address right now. But if you've got questions, put them in. Otherwise, I'm just going to give a few random tips here through the last 10 minutes that we have. So we did get one question here from James Ryan. What types of software are recommended for cash flow management? And that's a very hard question to answer with this audience because it's very diverse. So I'm going to say that's going to depend on what accounting system you're using. Are you using NetSuite, Intact, Xero, QuickBooks, online or desktop, or Sage or some other product? The answer is going to depend a lot on that. And then the other thing you need to think about is, what do you want to get out of cash flow software? Do you want to do short-term forecasting, like on a daily basis? Do you want to do more of a long-term planning? Do you want to compare scenarios? Do you want to have a scorecard that you're looking at frequently? So those are all things to think about. I'll just throw a few ideas out there for cash flow forecasting. We have used some of Finagraph's cash flow tool. So that's cashflowtool.com, and that integrates with QuickBooks Desktop and QuickBooks Online. That works very well if you want kind of a short-term day by day, a calendar view of your cash flow. Are you going to be able to make payroll kind of questions? There are others that we use as well. So Dry Run is another one that integrates with a few more packages like Zero, Intact, and that one will give you the ability to compare scenarios for cash flow, and can also give you that scorecard that you can use in your planning meetings and with your management and all of that. We've also used a bit of Fathom. Fathom is a little more high level. There's another one out there called Girave, so Jirav. Girave is another one that can do some forecasting as well. So there's several different accounting systems and that do forecasting, and so I invite you to go out and take a look at those, or consult with us on what's best for you. So while we wait for questions to come in, I'm going to share just a few tips here. Now, can you do forecasting in Excel? Well, you can. Now, it's not going to integrate with your accounting software. So if you're doing forecasting in Excel, you might just be reinventing the wheel every time you go in and do this. So, but if you are, I do want to share this tip right here. And this is a tip in Excel, a feature called conditional formatting. So what you see right here, and I'm gonna annotate the screen as I'm talking here. So what you see right here in this before column, this is kind of that traditional cash flow or budgeting report. So what you've got right here is you've got actual, and you've got a budget column, and you've got a variance. Now you'll see right here, there's an F here for when the variance is favorable and when the variance is unfavorable. So this is how I learned how to do this in school. This is the traditional report, simple subtraction calculation, and then looking at the variance. Well, what you can see down below in the after, now we're putting a little more color in the report. We're making it a little easier to read and quickly spot maybe where things have gone over budget or under budget. So you can do this all with a thing called conditional formatting. You can see this button right here on the Excel ribbon. So conditional formatting now will color a cell based on what the amount is. So you'll see right here, now this is way over budget, and we've got kind of a dark red right here for salaries expense, and you'll see the ones that are under budget are green right there. So this conditional formatting just makes it a lot easier to look at visually where you're over budget and where you're under budget and how much, and it's easier to understand, maybe much more even for the non-accountants. So give this tip a try in Excel. We'll go on to the next slide. Another tip here for controlling what your employees spend. If you're struggling with budgeting, can you make those annotations go away, Amy? So now, a lot of companies have done employee expense reimbursements historically, and the problem with that is the employees spend money from personal funds and then get reimbursed. And there's lots of problems with that. It's a cumbersome process. Expense reports may not get filed for a few weeks or months. So there's an information lag, and employees may not follow company policy. They may go over budget. So the solution I've seen many companies adopt is that rather than after the fact employee reimbursements, they're giving company credit cards to employees and then integrating that with accounting software and doing this to enforce budgets. So the advantages of doing this is that you can request and approve budgets with the phone app, and you can get real-time information the second that a credit card is used. And all of this integrates with the accounting software for your categorization and such. So this is something you may want to consider if employee reimbursements are a contributing cause of things going over budget. The app that you see here in the screenshot is called Divvy. So this may be one you want to take a look at. And the next slide here, this is just a quick slide here, the importance of understanding your customers. So one point here, if you want to grow your business and improve your cash flow, it's often more effective to focus on top line revenue. I've seen companies be able to solve the cash flow problem by growing sales and having more sales. I've also seen companies try to cut costs, and you may be able to cut some costs by 5% or less, but if you're able to grow your top line revenue, that's going to improve the health of your business. So some things you might want to look at. So monitor the customer metrics, new customers, repeat sales, customer retention, and collection effectiveness. I see what happens a lot is companies just use that accounts receivable aging schedule to try to improve their cash flow. And that certainly has its place, but there are other things you need to look at. We've got a few questions that I saw just come through. What was the first one again? Can you list them here with the spelling of the last two? Okay, great. Thanks for typing that in. Jackie.
I'm not sure if I got them all, so.
Yeah, cash flow tool, Fathom, Giraffe, and Dry Run would be another one to look at. And there are others. Look in the QuickBooks App Store, look in the Xero Marketplace. There are other products as well out there. Great, don't see any new questions yet. I do have one more slide. And so I recommend here making a periodic evaluation of your cash flow. So look at it weekly or monthly or quarterly, kind of plan out what you're going to do on this type of basis. You'll see here on the right, this is as I make this go away. Okay, there we go. What you see over here on the right is a scorecard showing different aspects that affect your cash flow. This is something that you could monitor frequently, maybe weekly, maybe monthly. See how the health of your business is as it pertains to cash flow. And just a word about our services, what we do in our department at Eide Bailly. We can work with you in many different ways. We could be just monitoring your cash flow. That's kind of that first step you see there. The second one is we can take a more active role in helping you manage your cash flow. So this may be looking at it more frequently, strategies to improve your cash flow and such. And then the next one is modeling. So this is making a future looking report with using certain assumptions and scenarios, looking at how certain events would affect your cash flow and using all of this information to help in your decision making. So great. Well, I don't see any other questions in the chat, so I think we can wrap up.
There was one about budgeting software with Microsoft Dynamics, Business Central 365. If we know of any that would integrate. I don't have any off the top of my mind.
Nor do I. Yeah, that's a software we don't run into a lot, but
not that there's not any out there.
Yeah.
Well, awesome, guys. Thank you all so much for attending. Thank you to our awesome presenters. And we hope everyone has a great Friday, and we will see you guys next time. Thanks, guys.